Hi everyone, this is Sandeep Anand. The legendary investor Peter Lynch had once said, if you talk about economic conditions and macroeconomic factors for 10, 13 minutes a year, you're wasted 10 minutes. And I'm a big proponent of that. I do not believe that people should try to time and dance to the tunes of potential market conditions based on the economic factors, especially macroeconomic factors. And trying to time the market is just a futile exercise. But it's also important to understand what some of those market conditions are based on the economic factors. What are those economic factors like inflation, stagflation? Where are we currently? Where is it headed to, at least directionally? So that you could at least understand directionally the where which edge it is leading to. And if you understand that, it helps us to downside protect our portfolio and at the same time upside help in aiding towards the upside surge in both edge conditions. Now we are leading to one of those edge conditions potentially, but at the same time, I want to walk you through what inflation, stagflation, and economic macroeconomic conditions and factors means. What are those leading indicators? Because today we are talking about an S&P 500 that was trading at 2200 in 1 year back, and currently it's trading at around 4500. Just a year, the largest index globally has doubled. And the inflation numbers that was recently published, I think CPI was around 4.5%, and core inflation was around 5.5%, which is the highest since 2008. And 2008, we all know how the market conditions were. On one side, Fed is pertinent in retaining the interest rates at close to zero levels, and continue the stimulus programs. And at the same time, they are calling this inflation as transitory. As common investors, how do we understand these terms? What does it mean for an average investor? And how he or she should position the portfolio in such a way that you do not go too much down from all the gains that you had from the bull market. And at the same time, you also benefit from some of the factors that causes the inflation. Let's get into that. Now, on your screen is a basic definition of inflation, which is increase in price levels of goods and services in an economy. Pretty much that's all inflation means. And there are two basic types of inflation as per the neo economists, which is demand pull inflation, and on the other side is cost push inflation. And there are many other types, but I want to call out the main two types categories. Now, what is demand pull inflation? It just means rise in demand of goods and services resulting in price level increase. So the price level increase is caused by the high demand of our goods and services both. Higher demand due to fiscal stimulus in the economy. What are some of the causes for that? Higher demand due to the fiscal stimulus in the economy. Monetary stimulus, falling interest rates causing price inflation. Example, housing boom that we are seeing currently. Pronounced pent up demand. It could be due to the high pent up demand and sustained pent up demand for a long period of time. Now, on the other side is cost push inflation, which is supply side led. So earlier it was more towards the demand side, and now it's more towards the cost side. So increase in cost of production can result in prices going up. Obviously, when the cost of manufacturing, cost of producing, cost of servicing increases, called COGS, which increases, the prices increases, right? So the primary causes for this cost push inflation is rising wage cost, high raw materials cost leading to high direct costs and COGS, that is cost of goods and services. So high raw material cost can increase the direct cost of manufacturing or producing. And the third one is rise in import costs due to currency depreciation. When your currency is depreciating, with respect to relative to the other currencies, your import cost can go up, which can hamper and which can increase the cost, direct cost, and it can cause a rise in prices. So pretty much these are the broad level conditions that can cause inflation on the supply side, that is a demand on the cost push side, and the other side is a demand led. Now, stagflation. This is a term we need to understand because it has happened only once or twice in the global markets until now. What is stagflation? It's a situation in which the inflation rate is high, the economic growth rate slows, and unemployment remains steadily high simultaneously. Now, a factoring, a conducive condition where all three exist. That's stagflation. It's combination of stagnation, economic stagnation, and high inflation. That's why it's called stagnation. Now, in this state of economy, which is experiencing a simultaneous increase in inflation and stagnation of economic output, it's obvious that the end result is going to be stagflation. It was first recognized, I think, based on my analysis, it was in 1970s in UK and other developed nations. It happened. It spread into the other Western world in 1970s. Now, economic growth slows. Let's understand the two major causes of stagflation. The first cause is economic growth slows. That is, there's a supply shock to the economy, and a supply shock looks like a rapid increase in the price of materials, commodities. It could be cost led primarily. It could be a supply side constraints due to the supply chain constraints. All of that can cause a rapid increase in the prices. And on the other hand, there is a flare up of prices at the same time and slows economic growth by making production more costly and less profitable for companies and economy. So these goes hand in hand. These two levers on the economy, that's one that pushes and produces that supply side shock, which causes a rapid increase in the prices of commodities and materials and other things, which flares up the prices at the same time of the end products, consumers' products, and slows economic growth because the production becomes more costly and the it is less profitable for companies, right? That's the first cause. That's on the economic side. Now there is another part to it which is caused on the government side or the federal side, on the state and central side. Now this is a synchronized cause for stagflation. The government creates situations that can harm industries. Examples: free money stimulus causing wage rise, and at high attritions and labor shortage. These are all kind of intertwined. So, for example, when the conditions are such way that people have lot of money in their accounts, like they have a lot of cash in hand, and they refuse to go back to employment, and that causes wage inflation, the lack shortages of labors, and it causes the shortage of labors cause high attrition because there is elsewhere people trying to migrate for higher salaries. That causes further shortage. So it kinds of the situation is caused by it's caused by the government actions and to a great extent state and central actions on the industries. Now the other part, which is the other lever, is coexisting fiscal and central systems growing the money supply too quickly, too fast. So fiscal is nothing but acts by government, and central systems are the banks, central banks, growing the money supply too much. There is too much liquidity in the system. Money supply is circulating too much. It could be on and off. It doesn't have to be high all the time. And this kind of a synchronized, thing causes stagflation. Now, these are the two broad causes that can cause stagflation. Now, let me bring you some history very quickly, just a couple of slides. So, first is John Maynard Keynes, the famous economist. He had written a book, The General Theory of Employment, Interest, and Money. This was, I think, published in 1936. And it's called Keynesian economics. So Keynes, it's Keynesian economies. The Keynesian economics developed after the Great Depression. This was primarily, it came into existence after Depression and during the World War time. And the ideas presented by Keynes in this book, General Theory of Employment, Interest, and Money, was propagated and made as a Keynesian economics. And there is a lot of following economists following this Keynesian economics. Now, they refuted the existence or a possibility of a stagflation until it occurred in 1970 because there was no precedence. And until it occurred in 1970, Keynesian economists refuted a potential existence of stagflation. The reason for that is also attributed towards something called as a Phillips curve, which is a mapping or a graph between inflation rate and unemployment rate. The Phillips curve is an economic correlation, and it's a curve that indicates it indicated that inflation and unemployment have a stable and inverse relationship. So they are inversely related, inversely proportional. The theory claims that with economic growth comes inflation, which in turn lead to more jobs and less unemployment. But this was, before the era of before 1970s, where it was never thought about having a stagflation kind of picture. And this was refuted by the stagflation that occurred in 1970s and 80s. And when it occurred, it became obvious that the relationship between inflation and employment was not necessarily stable and predictable the way it is shown in the Phillips curve. That the Phillips curve itself could shift. That's what was arrived at the end of 1970s. Now, we also need to understand the macroeconomist theories that exist out there. Post 1970s stagflation. It's called Neo-Keynesian Model or New Keynesian Model. And Milton Friedman, another famous economist, uh, he stated that when workers and corporates begin to expect more inflation, the Phillips curve shift up. This means more inflation occurs at any given level of unemployment. It is not necessary that employment should be at high levels and as inflation goes up. Now, in particular, he suggested that if inflation lasted for several years, workers and firms would start to take it into account during wage negotiations, causing workers' wages and firms' costs to rise more quickly, thus further increasing inflation. So it gets into a spiral. And neoclassical explanation of stagnation after it occurred was that it causes the stagflation causes include inefficient government regulations or high benefits for unemployed that people that give people less incentive to look for jobs. I'm sure many things are rhyming, right? Now let's get into the next slide. What is mixed inflation? Now, we spoke about demand pull inflation and cost push inflation, two factors. There could be a mixed inflation possibility, right? Now, it can go in a what do I say, like in a concerted manner. So, demand pull inflation is price increases precedes wage increase. High demand will raise asset prices, causing asset bubble, which will in a short time pull up money wages. However, the rise in money wages is not driven by cost push forces. So, in demand pull inflation, it is not driven by cost push forces like money wages alone. Now, push inflation, it's situation where wage increases precedes price increases. Now, you need to think through this line a little more deeper. If you read between the lines, it shows that wage increases precedes price increase. Can it be that instead of wage, can it be that free money or easy money, a lot of money in hand, can it increase the spending power? Can it increase the price? Can it increase the cost? And when there is a supply side constraints, what would happen? Let's understand. Now, where are we today? That's more important. We foresaw all the economic theories, but comes to practically, where are we today? Current scenario, well, where it started with money flowing in, a lot of liquidity gushing into people's hand, into corporates, into due to the lockdown scenarios and all. And then following that, there was a pent up demand, which caused rather a demand, higher demand. I wouldn't even call it pent up demand at that point of time. A higher demand because of the affordability, driving prices higher, causing asset inflation across all the markets. And then there is a pent up demand which is playing out now, and a potential higher pent up demand in the future. And at the same time, there are supply constraints that has been created due to the shortage of materials. Commodity prices were at all-time high. People even called it as a birth of a new commodity cycle. Well, things changed a bit after that because the expectations got changed and shifted a bit downwards for the commodity markets. And then there is labor shortages that we see in the recent results of almost every company. They're saying labor shortages as one of the main issue. Lyft published their reports and they are saying, they're not able to register new drivers or existing drivers are moving out and, the new partners are not available and there is huge labor shortage. And And on the other side, there are corporates worrying about wage increases. Chipotle recently published, they increase the wages. Many industries, in fact, many corporates are rising the wages like anything. Attrition rates are at the peak. People are switching jobs like anything. Many people are not even returning to employment. People switching jobs at a higher rate of 30, 40%, 50%, even doubling their salaries in a manner. And attrition rates at 30, 25, 40%, which is never seen before. The inflationary pressures will continue with sustained increase in demand, shortage in supply, and rise in prices. This should be sustained. Now, what is Fed saying? These are all transitory. Now, the theory states inflationary, and practically when it happened, it showed that the inflationary pressures will continue sustained with increase sustained in demand, because we can anticipate a 2 years of pent up demand ahead. And there is a shortage in supply due to supply chain constraints, many other issues that happen, lack of availability of materials, huge demand in the digital shift. And there are multiple galvanizing factors which is driving towards stagflation. The main two being, stimulus in people's accounts. There is a lot of liquidity in the system. Fed is pumping in every month, and there is a high demand and high pent up demand which is in future in prospect. Lack of monetary and fiscal powers with Fed, in future to control, because it's already handled to the best possible way, to the maximum possible way. The rates are squeezed, it's almost near zero. Stimulus at all time high. There is only so much power that central banks have globally, not only Fed, to further control the situation. It can all lead to a spiral effect if not acted in time. Now, I am not an economist. This is my analysis to show based on history, because history does not repeat itself, but it rhymes. And based on the analysis, it clearly indicates that this is well on its way to become uncontrolled spiral. Where are markets? Now, this spiral can be detrimental to the portfolios when the markets are at, it can be a poisonous mix, potent, that can cause, that is a ticking, that is really ticking, because the markets on the other side is at all-time high. Asset bubble is peak. History indicates that stagflation can cause market corrections or even a crash, especially when there is asset bubble across all segments of the market across the globe. Now, current exception, I would say, is Chinese stock markets. They are not in a bubble. They are, in fact, at all time low, which can potentially have some runway ahead, which can cause the markets to sustain for some time, because some of the emerging nations, and especially China, is way at the ever time low levels due to regulatory conditions and many other macro factors. But that is the only exception where the asset prices are not all time high, and that can have some runway ahead. But potentially, if you see globally, all asset markets are at bubble levels, as Howard Marks said. Now, the best example indicator of this is Schiller P, which I follow very closely. Now, this is source is multiple.com. I think you should visit the site. They pretty much track beautifully all these factors, and the the chart out there shows when all the as Schiller P, which is nothing but it considers the inflation into the factor. That is only difference. And so the inflation adjusted PE, price to earnings, is Schiller P, and in the Schiller P, you could see that in 1929 it was at the peak, 30. Then in 19, I think 70s, it was nearing to the peak when it kind of the inflation levels were crazy. And then it was uh, in 2000 Nasdaq bubble, the highest ever, which was around 45. And right now the inflation adjusted, earnings adjusted, which is important because many people can argue that the potential earnings are not fully factored in. Even if you factor in, it's still at a all-time high, near to the second level, that is 38.5. And it could potentially be headed higher if some of the areas of pockets of markets where especially the old economy stocks, the old economy companies, some of the industrials, energy, banks, some of the consumer led discretionary names, those pockets are still not in bubble zone. And at the same time, as I said, China and some emerging nations, if they come to that levels, you could expect a global phenomenon of asset bubble across. So especially this is only for US market, the Sheila P. So there are pockets which are still trading at not so high levels, which might reach that level, so we can anticipate it's on its way when the trade opens, when the reflationary trade opens ahead. Now, Sheila P is 50% higher than the last 20-year average in the US market. Inflation is at, highest ever since 2008. Interest rate is the lowest level. Liquidity has the highest level. Market conditions are pretty much nearing to the highest level. Now, how to protect your portfolio from downside? All this is good to hear. That's, as I said, I spoke almost 10 minutes of macroeconomic conditions now. How much of it's really useful for practical action, but how to downside protect your portfolio in such a way that you really don't need to worry about all these things when it happens. Well, the idea is not to take out cash and stay outside. I mean, it is not a really great idea to sell out everything and book capital gains, pay capital gains, and stay out of market, because usually the bubble market, the bull markets give the highest returns in the last leg, and it could go up 3 4 times. And I don't think we are anywhere near the third leg, and so there is still time to go. And but we should start preparing towards the edge condition. So the best idea would be invest in companies that has the pricing power and need to have the competitive advantage. I mean, the age-old saying from Warren Buffett, having the moat. So companies that has pricing power, the advantages, they can pass through the pressures, the cost margin pressures to the end consumers. That's the pricing power. And very few companies has that power really. And if you find companies like that, you should really position some percentage of your portfolio towards that, not that all in pricing power. If it's very difficult to position like that, so at least 30% of portfolio towards companies that have high pricing power and competitive advantage. And when it should be part of your selection criteria itself, because companies will not have high return on capital, invested capital, if they don't have that pricing power. So if you qualify for your selection criteria, it will be taken care. Now, invest in companies generating free cash flows and throw dividends. So another important point I missed here probably is the debt factor, because debt is going to hang. The obvious factors are inflation can lead to high interest rates, which can act like a gravity, as Warren Buffett said, on the market and on the economy, on the companies. So when the interest levels goes up, level goes up too fast, right? It can hurt the companies which has high debt, because the cost of capital goes up, and cost of COGS, that is cost of goods and services, or cost of production, manufacturing, supply, everything goes up. Material cost all goes up. It applies heavy brakes on the margins, so the companies might not be able to sustain that. So you need companies which has low debt on the books, which is missed here. Apologies for that, but it should be low debt on the books, high free cash flows, which has the capability to throw dividends, because dividends can be a good hedge for your inflationary portfolio. I mean, for your against inflation, as well as against the recession conditions if it comes through. And diversify across markets, assets and sectors, which is very important. Not to concentrate heavily only towards tech. Especially I see a lot of investors having 90 95, pretty much 100% of portfolio in tech, which is a high risk, because tech can be pricing in a lot ahead. And if the discount rate at which it's priced in, the pricing in the future goes up, the de-rating can happen in the tech industry. So diversifying across industrial economy, old economy. As I always say in my framework, there are three pillars: asset-based framework, asset-based value, earnings-based value, and exponential growth-based value. So you need to have across all the sectors. You need to find the bargains. Have, finally, most important thing, keep at least 10% in cash to take advantage of a correction or crash. So having a shopping list, a wish list ready, and keeping 15%, 20% cash, preferably, if not at least 10%, so that when a correction hits us, we are ready to pounce on the opportunity and double down. So this is all we can do, and not worry about the macroeconomic conditions, how it's going to affect. And once we take care of this, our portfolio will be taken care as well. Thought of bringing this to my audience. Thanks for staying with me. Signing off, Sandeep Anand.